It's a lot of pressure. I now have my room muted, so I'm just talking over here.
Yes.
Love the graphic.
Welcome to preschool.
Yes. I'm in the room, but I'm listening to you over Skype.
Yeah, I don't think that counts.
You may have to type it out, Joel, see if they can. Okay.
Phone. Is this good?
Yeah, you're good to me. Good to me.
I
Do
can hear
you
you.
hear it over in the room though? Let me see if I hear it. Do you hear it in the room? Yep. Okay. Okay, that's all I needed to do. I'll move this down here just for the heck of it, guys.
Yeah, they got you. I
Yeah.
see.
Yep. Okay, we're going to start the show up.
Fry guy,
Everybody,
get my email?
right guy, stay around cuz maybe we'll use you too, buddy.
Yeah, let's use Bry Guy.
We're going to be in the main room. In fact, you won't have it won't be in the chat room, the main chat room. McMill asked me that. So everybody stay in the main chat room. This is not a thing for the options room. This is for everybody that's in the room. Okay. Excuse me. Bry guy, you are not useless. You are as useful as everyone I know. Wonder what that means, Tommy.
I don't know, but he's got a full toolbox. That's all I know.
He's got a good toolbox too.
Yeah, I know. Like one of those tall craftsmen that's over your head.
That's right. That's right.
Way to go, Bry guy.
Okay, so we're going to see about enrolling everybody in preschool, but not just preschool. We're going for options preschool part 2. Okay, but let's learn in a little different way because options can be really, really difficult when, and this is what I've been told. For me, I've taught options a number of times, but generally, what occurs is I try to do it in what I think is an easy way with Greeks and Tommy, you know what I'm saying. All this stuff that's so easy.
And I will not mention the olive oil.
Not the olive oil either, please. But we're going to do it in a preschool method. So I'm going to show you something that's a little different way of thinking, but it still works to give you the concepts. Okay, so let's say that I own a piece of paradise. Nice looking, huh? It's worth $1 million. That was what it was appraised for, so it's going to be worth $1 million in value. You'd like to own my piece of paradise, but you don't want to spend the $1 million right now. So what can you do? Okay? This is just like you want to own Apple, but you don't want to buy 100 shares at $702. God, it was just 640 a week ago. $702, right, Tom?
Yes.
You want to get it so that you can buy it cheaper, but still get the appreciation of the Apple or of my piece of paradise. So, what do? Well, you think for a bit. And you sit in your little thing and you think for a bit.
That's Learjet doing in a bucket.
I tried to bring him along, but you know. So.
He must have fell asleep.
Oh.
Aha.
He's sick. We can't pick on him.
Really, we can't pick on Leah right now.
Oh, yes, we can.
Aha, you say.
Sonny, you are mean.
No, I love him. I only pick on the ones you love.
I'll create a contract to allow, this is what you're saying, to allow me to buy Trade for Pay's piece of paradise in the future. Okay? So, not now, but in the future. So you come to me with your contract, and the contract sort of reads, I receive a transferable. In other words, I can sell this contract also with the right to buy Trade for Pay's piece of paradise for $1 million within 1 year. Why would I do that? I wouldn't want to give you my piece of paradise for the price that it's worth now, but for this right, you're going to give me, Trade for Pay, a non-refundable $100,000. So you're going to give me this contract and $100,000 so that I give you the right to buy that piece of paradise within 1 year. And if we agree, you've just created a call option for my piece of paradise. So really, what you've done is you've created an obligation for me to sell you a piece of paradise within 1 year, and for that you have the right to buy that piece of paradise for $1 million, what we agreed upon. You give me your $100,000, and you have rights, and I, as the owner or as the person that wrote the call option to you, I have obligations, you have rights. So,
Okay.
Joe,
yeah.
Since you started with this property, I keep thinking land contract.
Stop.
Is that
Don't get
similar?
any more. Don't get any more. It's a contract only for the rights to buy it. Okay? Don't get any more than that.
Okay.
Hey, Bry Guy, get a compass.
Okay.
Or GPS, even better. You'll find paradise.
Okay. So what does this mean? Okay? You can buy the piece of paradise for $1 million. You gave me $100,000. Now, there are contracts on land, but don't think of this. This is a contract. It could be to buy 5,000 bushels of corn. It could be to buy 42,000 gallons of heating oil. It could be to buy 1 million fans or 10 million pairs of pants. It doesn't matter. You haven't taken control of the property. You just gave a contract that says, I'm going to give you something up front, and you have the right then to be able to buy it at some time in the future, whatever this stuff you want to buy, your contract gives you the right to buy that, but you're giving the owner of that property, whether it's pants or property that's paradise, you're doing that by giving that person some amount of money or something of value. We're saying that's $100,000. So what happens if the price of paradise, my piece of paradise, drops to zero? Well, here's the price of paradise on the bottom, okay, at close of 1 year or when you close the contract. Here, remember, we're looking for risks and rewards. So here are your risks below. This is loss of money, and your rewards on top. So if the price of paradise, my price, goes to zero, man, they just found a whole place full of paradise, and paradise dropped in value, you would lose what you put up. No more. Just the 100,000. Well, what about if paradise goes to 900,000? You'd still lose your 100,000 because you don't want to give me $1 million for something that's worth 900,000. So you would lose your 100,000. What about if paradise goes to 1 million? Well, you may buy the property for $1 million at that point, and it's worth $1 million, but you still would give up that 100,000 that you put up, right, guys?
Yeah.
Okay.
Yeah, I got a question though. If
Okay.
it goes to 100,000, can I exercise my contract before the year is up?
Okay. In this case, we're saying it's transferable, and in normal call contracts, yes. Okay?
Okay.
So let's not make it more difficult than that,
Okay.
but that's true. Okay?
Got it.
So, let's say it goes to $1.1 million. The value of what you have to pay me, $1 million, plus your 100,000 that you put up. So at $1.1 million, you've broken even. Okay?
Okay.
Now, let's say that you go up to the price of paradise goes to $1.5 million. How much did you make?
400,000.
300,000.
Okay, 2 answers came out. Which one? How did you come up with yours, Patty Cake?
Because I paid 100,000 in the first place,
Right,
and then if it's at $1.5 million,
right,
then my cost was 100,000, so I've made 400,000 on that.
right, because you're also taking out the $1 million.
Right.
So if you want to figure it out, add the million to the 100,000, subtract it from the value of the land today, okay? And that's the value that it would be worth at exit, at closing. Okay? Now, don't equate this with what you get into when you're looking at real calls, because they have different things because you can move them in the middle. I'll just say that. But this diagram here is called a hockey stick diagram. And if you notice, that hockey stick on the top right goes up at that angle forever. In other words, you have a maximum loss of 100,000, but you have unlimited gains. Okay?
Got
This
it.
is the benefit of buying a call. Okay. As opposed to me, if my land went to 0 and I didn't sell it to you, I've lost my $1 million. But if it goes up, I don't get pinched off at a certain price, $1 million. I get to keep going. So my diagram is a bottom left to upper right diagram without having a contract on it. Okay, let's keep moving. Was that clear to you guys of how to calculate profit and loss?
Yes.
Yes.
Good. Okay. But what if we don't agree? I mean, hey, after all, this is trade for pay.
Roll.
So I offer you some choices. Choice 1, I'll sell it to you, my piece of paradise. It's worth $1 million today. But I'll sell it to you for $900,000 in 1 year, within a year. But instead of giving me the $100,000 that we did before, you have to give me $150,000. Okay, that's type 1. Contract option 2 is what we did before. $1 million. Okay. You give me $100,000 and it's still good for a year. Number 3, you have to pay me $1.1 million, but you only have to put up $50,000. Benefits to that too, guys?
Yep.
Okay. Still a year. Now I offer the last one. And this is, you still have to give me $1.1 million. But in this case, you have to give me $100,000. But the difference for you is you get 2 years that the property could go up rather than only 1 year. Okay?
Yeah.
Now, what happens if the purchase price decreases after I pay you? Sailor Dude, that's what I'm going to show you. But that's basically what happened back in the first one. Okay, and I'm going to do it. Okay, in the room, if you're listening, okay, and as soon as the room puts in, put down 1, 2, 3, or 4, which choice you like best. No, one is the most, we'll see. Captain Trader.
A lot of threes. I see a lot of
A
threes.
lot of threes.
Kumar's lost.
I see
He's got
3
5.
threes.
That's like that Peyton Manning commercial with the pizza guy.
Yeah,
The guy kept saying $1 million, and Peyton Manning keeps saying $2 million. That's his problem. He can't count.
that's right. Okay. So actually, Tomahawk, what would you say?
I would say 3.
And I'll say you don't know.
Ooh, ouch.
Right? Nobody knows.
That's why I'm a rookie.
Well, but think about this.
And I can't see the future. But I'm looking at the leverage here. But that's a whole different topic.
Okay, one of the things that many people do is they go for 3. They buy way out of the money. Now, this isn't that far out of the money, but they'll buy way out of the money and then find that it doesn't go there, and all at once, what they hoped they would make money on, if it goes there, you make big bucks.
Right.
But the problem is that it often doesn't go there. Okay? So it depends, and we'll get into that. And Tom, that's one of the things you and I can cover a little later on.
Okay.
Okay? Because it's true. You can't just say in a vacuum, not knowing the market, which of these are the best. Okay?
Right.
You tricky thing, you.
Of course. I'm trade for pay. So, now.
You got me, man. You got me.
That's tricks for pay.
That's right.
Yeah, there you go.
If you think about it, why would I offer somebody $900,000, but you got to give me $150,000 instead of $1 million, and you got to give me $100,000? Okay, if I think the thing is going up in value, would I want to do that at all? Because you're already in the money. Okay? Now, here's the deal. If this goes to 0, you've lost $150,000 and I lost $1 million less the $150,000 you gave me. So I only wound up losing $850,000, not my $1 million that I would have lost if I hadn't have given you this contract. Okay?
Got it.
Okay. The next option, if it goes to 900, okay, what did you lose? You lost. I mean, you could buy the contract for 900,000. That's not a problem. Okay, but you put up 150,000, so you still lost your $150,000. You can now own the property for 900,000, but you did lose your 150,000. What did I make? Well, I still made, the 150, but now I took in 900,000, got 150,000, so I still sold my property in essence for $1,050,000. Okay, so is this good? Could be if it shoots way up. Okay, at $1 million that it's worth today. How much did you lose? Well, you gave me 900,000 plus 150,000 is how much, guys?
$1,050,000.
Yeah.
Yep. And how much did you have to pay me?
$150,000.
50,000.
Okay, so you gave me 900. You gave me $1,050,000. The property stayed exactly where it was at $1 million. So what did it cost you? What did you wind up losing for risk? Because you gave me $1,050,000, and the property's only worth $1 million.
50,000.
50,000.
There you go. See how you do it? Add your price that you're putting up. Okay. Add what you put, the price that you have to pay for the land, the underlying, I'm going to call it. And I call it underlying because even in regular even if it's regular options, there's options on ETFs, there's options on stocks, there's options on futures. There's a lot of different options. There's options on bonds, there's options on FX trades even. So I'm going to say that my piece of property, my piece of paradise, is an underlying piece of something. Okay? Could just as easy be stock, could just as easy be corn, could just as easy be a number of pants. But you would have lost $50,000. Add the value that you had to pay for the underlying, plus what you paid for your contract rights, and subtract that from the value of the property at closing. Now, where do we make our break even for you? Add the 900, add the 150. You break even at $1,050,000. Okay. If it goes to $1,250,000, how much do you make? Well, you make $250,000. I'm sorry, 200,000. Sorry, 1,200,000. So that's choice one, and this is your hockey stick. Why do they call it a hockey stick? Because if you look at a hockey stick, what's it look like? That exactly.
Got it.
Okay. Here's the other one that we already went through, so I'm going to go through it quick. Here's 3. A lot of you liked 3. Okay? No, Sailor Dude, that's the benefit. Okay, Sailor Dude asked in the room, do you have to buy the property if the price goes down? No, you have the right to buy the property. You don't have any obligations. So what you look at is the call contract. And this is true of the real ones. If you buy that call contract, you have the right to buy the underlying, but not the obligations. So no, if it drops to 0, you've lost what you put up. And that's, that's not good either. But you haven't dropped property value like the guy that really owns the Apple or the VHC. What's VHC? Doggone it. Hit me too hard, Tommy. Or the piece of, paradise. Vertex. Okay. So do you understand, Sailor Dude? That's why these can be better in some cases. You can lose 100% of your money, but that money doesn't have to be near as much as if you bought the underlying and it went down. Very important. Okay, here's our third choice. A lot of people like this one. Why do they like it? Because it's cheap. Okay? And I made this same mistake too. Ooh, if I jump into this stuff, and I only pay, $50,000, man, I'll make a fortune percentage-wise. But what happens is if it doesn't hit the 1,100,000, I paid less, but I lose all of it. I lose less, but this happens a lot of times. Sometimes it depends. I'm just going to say this, and Tommy, you got to confirm this too. When it goes, when you buy this stuff, just like the real stock, the real future, the real ETF, whatever it is, you have to have an estimate of where it's going to, right?
Yeah.
Okay. If your estimate is it's going to go to 1.2 million, this may be the best one. Because you only had to put up how much, guys?
50,000.
8,000.
Okay? Rather than the 100,000 or the 150,000. So this may be the best one. But you have to have in your mind, for a good reason, the market of paradise has been going up. Okay? You have to have that. So let's see how this works. Well, now, remember, we always look and say, what happens if paradise drops to 0? Well, you would only lose 50,000.
Right.
Okay? Here at 1 million, the value that it was worth today, you're not going to buy it for 1.1 million if it's only worth 1 million. You just go in if you wanted to buy it and buy it for 1 million rather than use the contract. This is what you got to think about, Sailor Dude. If it drops to 0, okay, or it stays at $1 million and I got to buy it for 1.1 million, I'll rip my contract up, okay, and buy it for 1 million. I won't use my contract to buy it for 1.1 million when I can just go into the market and buy it for 1 million. That's
but I
why
lose my premium.
you lost your premium,
Right.
but you're not going to pay extra for it.
Got it.
Okay?
Got it.
And
Thanks.
Spent Cattle Camelot is much more expensive than my piece of paradise because it comes with a free magician. Okay.
And a sword and a stone.
That's right, and a sword and a stone. You know it, Tommy. See,
Yep.
That's why I got Tommy on here.
Even a round table, which makes Rainmaker obsolete.
Really?
Tommy.
Sorry. I had to get
okay.
my digs in.
Oh, shh. Okay, so let's say it goes to the 1.1 million. You guys are catching me up here now. Quit it.
Hey, Spent Cattle, it's not magic if you can pick up that sword with the stone and hit somebody with it.
Okay, so look. We can buy it for what's it worth today, 1.1 million. But we still lose what?
50,000.
Yeah. Okay, we can buy it for that, but we still lose, our thing that we put in. Okay, our contract cost. Okay, at 1,150,000, we break even. Now, let's say it only goes to 1,250,000. Not that much. We make 100,000, but we made that 100,000 on only 50,000. Okay, so this is why it works well. And there's our hockey stick again. Now, this choice is going to work the same as the others. Okay, at 0, you lose your 100. At the 1 million it is today, you lose your 100 because you got to buy it for 1.1 million. At 1.1 million, you lose your 100. But we got 2 years to appreciate the value of land. And at 1.2 million, 1,100,000 plus the 100,000 you put up, you break even at 1.2 million. And if you go to 1.5 million, you would make 300,000 on your 100,000, but you got a longer time to have that happen. Hold on. Okay, which you choose? How can you make an informed choice?
Do your homework.
Well, things you got to consider in your homework. What's the market of Paradise doing? Is it going up, down, or sideways? Okay. How's the market of Trade for Pay's piece of Paradise? Is it going with or against the market? Is it going faster or slower? Now, think about that. The market can be going up, and how many of you can tell me a piece of stock that didn't follow the market correctly? Tom, can you think of one?
Probably.
Okay, so you have two things. Is the market in general going up, down, or sideways? And what's Apple doing? What's VHC doing? What's CCR doing? What's one of them eBay doing? Are they going with or against the market? That's what you want to know so that you can consider, should I go back and choose which of those things? Okay? And what's your goal? Okay? Is your goal to take this and only get... Remember, we had a transferable contract. Meaning I could sell this contract to somebody else if it was making money, right?
Right.
Okay, so I don't need to buy the piece of Paradise. All I need to do is have Paradise go up in value, and then I could sell it to another person and say, hey, here's your contract so you can buy Trade for Pay's piece of Paradise. Okay? So, and when do you think it'll hit your goal? If you think your goal is going to be 2 years, which of those option contracts would you have bought? You'd go for number 4 because it gave you 2 years. If you think it's going to go up fast, if you hear, man, there's a big run and demand on pieces of Paradise, get in for the cheapest one. Get in for number 3. If you think Paradise is going to move slowly, maybe number 1 is best. If you think it's going to go up at a strong line, then maybe 4 is best. Yeah, you had a question. No, yes?
Who?
Oh, I thought you did, Sonny. Okay. No. And how long do you want to stay in the market? Okay. Here's how you got to look at this. Which of these offers a better chance to make money in your option? Okay? Both of them are measured in percentages because one's Procter & Gamble, the top one. The bottom one's Priceline. So, you know, Procter's in the $50, $70 range. Priceline's in the $400 to $700 range. So you can't use the the price, but percentage-wise, which one do you think moves better?
Priceline.
Yeah. So which one would you put a bigger contract, maybe the one that's that $50,000 for the $1.1 million, you'd go for Priceline. I wouldn't do Procter & Gamble very much, but if I was going to, Tom, what would you do? Have you ever played Procter & Gamble?
No.
Okay.
Not volatile enough.
Exactly. That's my point. If you're going to, you probably want to do it in the money pretty much.
Right.
that first one, okay? Get as much as you can. And you're right, and the volatility is a huge part of options, but really it's a huge part of the stocks also, or the underlying. Okay? So, another thing to consider. I sold you a contract, Joel, trade for pay. What did that do? That created an obligation for me. I got to give you this piece of paradise. Now, what about if I didn't own the piece of paradise? And I said, I'm going to sell it to you. I've just created a naked call contract. Okay? So, that's an obligation for me that I don't own the underlying. That's very, very risky. And we'll get into that in probably two times from this one. But since I already own the piece of paradise, my contract to you is the same as a covered call. I sold you something that really I own, and I can sell it to you. And if I don't have to sell you paradise, let's say I do the one that was the 50,000 and I keep taking in the 50,000. That's what you do, right, Tom?
Say that again?
Okay, you have the underlying stuff.
Yes.
You sell a covered call.
Yes.
You don't really want to sell the underlying.
No.
What you hope to do is keep selling covered calls.
Yes.
Okay? And that would make it good for me if I sold you number 3. I just keep taking in 50,000 bucks, and this is what Tommy and Learjet do. Basically,
yes.
Right?
Basic, yes.
Okay. Okay. So, to cover more on options, we had Learjet, and he pooped out, but we do have Tomahawk.
He's ill.
He's good. No.
Hey, there's a rocket on that Learjet.
That's right. And that's a Tomahawk.
Yes,
it's a Tomahawk rocket. So, okay. Tomahawk, what do you think so far?
I think this is great.
Okay. So,
is everybody having a good time?
In the room, put a 1 if you kind of understood what we're trying to cover.
Well, you know, trade for pay, we should get some questions first. You know,
yes.
For buying the call.
Okay, let's do that.
Anybody have any questions out there?
Do you get dividends when you hold call options? Actually, no. You get pulled away. You do not get them, but you get them pulled away. You get them the amount taken away. So you're not really caught is the thing. Can you resell that option with a different time period? Say that again.
So.
Now wait, I'm trying to say, are we going to cover the Greeks? Not tonight, Sailor Dude. What we did, put in a 2 minutes ago, I think I'm out of sync. Bri- don't worry, Bright Guy. You're well above this. What each of those icons do? No, I couldn't guess because it would take forever. Let's see. Who's got... Okay. Are we going to cover the Greeks? Can you resell that option with a different time period? Do you understand that, Tommy?
I think what he's trying to say is he buys a call and he's trying to sell it like probably a month later. Is that right, McMill? Kind of like a leap another month out? I don't think so.
No, you can't change. It's like
Right.
any contract. You can't go and say, hey, this was a good contract for this month. Believe me, if you do any... I'd love to be able to say this September contract has to be for October this time.
I've changed my mind.
Yeah. You don't get mulligans on these.
You're right. You have to sell the call to get out of it. And then you have to go to a different month and buy the call. And then if you want to get out of that month, you have to sell that call.
Right, Army vet.
And then if you can't sell it, you got to wait until it dies. A slow,
Right.
painful death.
Expiration.
Yeah.
Yeah, if you're talking what Bry Guy's talking about, that's basically rolling a contract.
Yeah.
Okay, and Bry, if
You know-
you want to, you could call in and explain that.
I think you can call your broker and have the expiry and not have it expire, but roll it into the next month.
Third Friday of every
Right.
month
Right.
for stock futures or stock.
Which is this Friday.
Right, which is what you call it, options on stocks are the third Friday of every month unless there's a holiday and then they make it, Saturday sometimes. Yeah, other ones, for the most part, you're right. I mean, futures are Thursdays, weeklies. A lot of people are trading weeklies. Weeklies are good options.
They're cheap.
They're very cheap. They open on Thursday and they close the following Friday. Okay? Okay, no, not rolling it, but seeing the option you hold for 1 year term, but selling it to someone with 6 months or 2 year term.
Huh?
Not sure
No.
I get that. Well, let me put it this way. Let's say that here's what I'm going to say. I'm just going to go down. Here's they just rolled a new one out for Apple. They got January 2015s.
Wow.
Yeah, that's a long time one. I'll bet you that's expensive. Let's see here. Let's see what we got on that. Oh yeah, that's $130 for At the Money. Okay, think of it this way. If I bought McMill, yeah, it is what it is. Bry Guy's got that perfect. I mean, when you buy it, you're buying a contract just like anything else. I mean, if you go and say, hey, I want to buy your house, and you put a contract, you could pull the contract and rip it up. But once I've signed it, we got a contract between the two of us. You can't come back and say, hey, I'd like to change the price. Not if I hold you to that contract. And to tell you the truth, there's no place to even go for options and have the right to change contracts. So what you can do, and some of the people put it in the room, McMill, you can roll, you sell basically the one you got and you roll out to another one. Anytime you want, though, you could sell the contract to someone else. But if they bought a February 2013 contract, you're selling them a 2013 contract. Okay? For a strike price of whatever the strike price is. Now, I didn't cover strike price, but Tommy, where do you want to go from here?
Well, let's go to covered calls and how you do it.
Go for it. What?
A to Z. When you get to your platform,
okay,
and you're looking at a stock, you want to open up an option chain. Okay. So, like, I want to do a comparison between Facebook and VHC because there's, Facebook's become popular now. It's starting to grow, and it's starting to get decent option chains on them. And I want to compare it with the volatility. So let's go Facebook.
Okay.
And look at October.
Okay, we got let me close September. By the way, guys, if you'll notice, there isn't a weekly in any of the contracts right now, any of the options. That's because we're in the last week of the month. So September's contract expires in 2 days. Okay, so what we basically have is only monthly contracts until this contract expires tomorrow, Thursday. We'll open up a new weekly that'll be the first week in October's contract. Okay, go ahead, Tommy. I got October, Facebook.
Are you there?
Yeah.
Can you hear me?
Yes.
Okay. When you pick a stock, you buy 100 shares. So Facebook is going for $23.29 currently. So it's going to cost you $2,329 to buy this 100 shares. So that would be one call. Now, there's a word of caution here. Certain stocks that you pick that pay dividends, your option chains, your premiums aren't that high because the benefits of having dividends is that you're getting paid every quarter, sometimes every month. You're getting paid a dividend. So you want an option chain that's pretty decent. Facebook has grown a little bit since I saw it yesterday. If we're looking at a $23 stock, let's say, I would look at just out of the money, and you want at least $1. You could sell it in the money and get $1.50, and basically what that translates to is $150 in your cash account right now. Okay, that's if you sold it in the money at $23.
But if remember, here's one thing to think about too, guys. Tommy doesn't want to sell it and lose his Facebook, right?
Right.
You want to get this money every month.
Right.
Okay, so if he has it in the money, that gives it to the people whenever they want. Go ahead, Tom.
You can turn around and buy it back and do it all over again. This is kind of like free money. It's just laying on the table. So let's say Facebook never gets to $24. You'll keep your stock, and you also keep this $1.05 for the $24 strike price. So your premium is $1.05. You get $105 in your account right now if you sold the call. Now, the downside of this, if it gets to $26, you don't get that extra. You only get the premium, which is the $1.05. And what I wanted to compare this to is VHC. And the reason why I play this is because of the volatility. And if you look at an option chain for VHC, the prices are similar. It's about $500 more. You see that?
Mm-hmm. $23 versus $28.
$28.82. So you're almost at $29.
Right.
So if you sold a 29 call, that would be $205, $2.05 premium, $205 in your account. And we're talking about waiting about 5 weeks, 4 to 5 weeks. So if this expires worthless, you know, it never met the $29 price. It went to $28.82. If you look at VHC, it's falling right now. So it probably won't get to $29. You'll collect that $205 and keep it. And plus the difference between $28.82 and $29. So does everybody get that?
No.
I'm with Sonny this time.
Help me out, trade for pay.
Okay. Let's look at it this way. I'm going to make it even easier. Forget Facebook. Let's look at Veridex. VHC. Okay. Right now it's $29. Okay. Almost. And if I go ahead and say, you know, I'd like to get 5% per month on my stuff, on my covered call. Well, I could go ahead, so I'm about $30. I could go to a 31 strike price. McMill, in this one, you want to own the stock. It's called a covered call because it's covered by your stock. Okay? Otherwise, it's called a naked call, and that is not good. Okay? I mean, it's okay. People do it, and professionals do it. But it's much riskier than what we're talking about. This is more an income type of trade rather than a make money trade. Okay? This is more, I want to bring in 5% per month times 12 months or what have you. So I want to look at 30, 40, 50% per year by doing this type of strategy. Is that what you're thinking, Tommy?
Yeah, and the other thing is you don't have to look at October. You could jump out to the next option chain, which is December. If you look at December, if you can wait a few months, and this is where patience come in, and by selling these calls, it buys you time. There's very little to do. All you do is you watch it maybe once a day, once a week, and you know it's like carefree. So
Set it
you
and
could
forget it.
Yeah, exactly. Like here, you could sell a December $34 call with a premium of $3.40.
And that's over 10%.
Right.
Of the value of VHC. So in, you know, October, November, and December, in 4 months, I'm sorry, October, November, December, that's only 3, isn't it?
3 months.
That's right. 3 fingers up, that's right. Our
math professor.
That's right, that's right. I are smart.
Arithmetic.
Yeah. So you could get this for $340, $350, say. And if it goes to $350 or to $34, you picked up $350 by buying your 100 shares of VHC for $28.90. Call it $28.82.
Yeah.
Okay.
So can I ask a question on that?
Go for
So
it.
does that mean when it's a covered call that is the most amount of money that you would make would be the $340?
No.
No, okay.
And here's why.
Go for it.
You bought the, let's say, $29 stock, but you're selling
Right.
a $34. So you
Right.
get that difference as well.
Oh no, but I'm
You
just
get
talking about
$5
the options.
difference. You get
Yeah.
$5 difference per share. So that's $500 on top of $340.
Okay, yeah.
That's
But I meant
$840.
option-wise. Is that the most amount of money you would make option-wise?
Yes.
Okay, that's what I want to know. Okay,
Yes.
thank you.
And basically, if you get your stock back and never reach 34, you find another option chain. Another month or two later, you do the same thing. It's kind of like rolling income. It just keeps coming.
Okay, I get that now. Now I get that.
In fact, what I used to do a lot was I'd buy a long-dated Apple call and sell the weeklies against it. Now, that's way down the road,
Yeah.
okay? But basically, think if you had VHC and you could sell it weekly, you could make some money just selling weeklies, okay? But Tom's got a point here that you're making in 3 months, you're making about 14% interest in essence by selling that $350 call.
Right. And there's not a bank in the country that'll pay you that.
Okay, so my next question is, does this same logic work with the naked calls?
No. No.
No.
A lot of them won't let you sell a naked call.
What do you mean?
Okay.
You have to own the stock to do this. A lot of your brokers won't let you just go out there and just sell, a call because maybe you don't
No,
have
I
enough
mean-
in your account or.
I'm saying like where you're not buying the stock at all. Like it's the same logic though, right? To determine if you think like down in December with the 34 strike price, if that's where you think that's going to go.
I've tried it on my platform. They won't allow it.
Okay.
They say it's illegal. They don't. It won't even go through.
Okay.
What, that you can't buy naked calls?
You can't.
For me, I can't.
Yeah, I can.
I mean, you must have a huge account, Trade for Pig.
Well, I mean,
Mine, they won't let.
and I've been doing it for a long time.
Right.
Okay, you need what? Here's the thing with naked calls. Okay. You have to give somebody. You just have an obligation with a naked call. Remember, what was my obligation when I sold you my call on your call? You sold it to me. Okay, or I sold you a naked call, or I sold you a call on my
you have
piece
to
of
give up
property.
Paradise.
Right. I have to give up a piece of paradise that today's worth $1 million, right?
Right.
Mm-hmm.
Okay. Now, when I do that, if it's not covered, if it's naked, okay, and paradise goes to $1.5 million, okay,
Right.
I picked up $100,000 because I sold you the call, right?
Right.
Right.
Okay. But what do I have to give you?
A piece of paradise.
A piece of paradise that I got to go into the market and buy for $1.5 million and sell it to you for $1 million. So what they say is the reason that naked calls take a level 5 option permit or right, I forget what they call it, okay? The reason it works that way is because you have unlimited loss. If Paradise goes to 2 million and I have to sell it to you for $1 million, yeah, I picked up 100,000 from you, Patty, right?
Yeah. Yes.
But I gotta give you a piece of Paradise. If I don't own it, where do I have to get that piece of Paradise?
It's not really my problem. You just have to get it.
Exactly. I gotta go into the Paradise market.
Right.
Just like if I don't own Apple and I sold, here, let's do this. Because Apple's one that does go nuts, right?
Yeah.
I mean, it's been pretty wild lately. Okay, so let's say that I go ahead and say, oh, no problem. 2 weeks ago, I'll tell you what. How would you like to have been, was it 8 weeks ago or 12 weeks ago at the most? Apple was $570.
Right.
Okay. I could have said, oh, no problem. Let's sell to Patty Cakes a piece of, a contract for October for, way, way out of the money. I'll sell her one for $650. A $650 strike.
Yeah.
Okay. Today, that $650 strike is worth $5,800. Okay.
Right.
But worse than that, I'd have to go into the market and buy Apple, 100 shares of Apple per contract I sold you. Sell them to you for $650 and buy it in the market for $702. So I'd lose 50 times 100, $5,000 on each contract. Unlimited loss. And way back in 8 or 12 weeks ago, whatever in the heck it was, it was 570. I probably would have thought, my God, 600, it's not going to hit 600 in 8 weeks. So this is why naked calls are very, very dangerous.
But if I had bought that naked call
Yes.
back at the $575,
If you just would have bought the
strike
call. If you just would have bought the call. Don't call it naked or covered.
Or sorry, yeah. If I had just bought the call, I don't own any stock.
Right?
But I had just bought the call way back when at a strike price of $575 because that was in the money, right?
Yep.
And it's going to expire, say, tomorrow.
Okay,
or
so we're going to
Friday.
go to September, right?
Well, whatever. October.
Yeah,
doesn't
well, we don't
matter.
have a... Okay, we'll go to October. No, September expires Friday.
Right.
So we'll just look at what your value would be. That's a good question here.
Because it would be Christmas for me, would it not?
Well, you probably would have paid for that about $12, $15 at the most.
Right.
Okay, it's worth today the 575 strike price for September is worth about 127 something.
Right.
So you
for
would have
me, it would be Christmas.
It would be 10 times your money, and you would be owing, the room a party at your place.
Exactly.
Okay, so do you see why? Now, don't get me wrong, I'd be very, very happy if I had done the same thing with the stock.
Oh, you'd be very happy too.
Right. The difference is this. With the stock, if I bought 100 shares of Apple at 570, I would have had to put up $57,000.
Right.
Okay. With the option, I would have had to put up 12 times 100 or $1,200.
Right.
Heck of a lot less for doggone more, not much more profit per se.
Exactly. So why wouldn't you do that?
Well, you would, except here's the risks so that people don't say, oh, I'm going to quit buying stock. I'm just going to buy options. Yeah. Remember what you can lose on an option.
The maximum amount is what you invested.
Exactly. Okay?
Yeah.
And it has a time limit. If you if you put up your 57,000, you own it for life if you wish.
Right.
Okay? But what you're looking at with the option is you have a time limit. So that's why I say the questions that you have to look at. What do you think it's going to go to? Okay?
Right.
And when do you think it's going to get there? And pat of cakes, I'd be at your party.
Me too. Are you kidding me?
I'd be flying you in. Don't worry.
Okay? Do you see? I don't want to make that this is magic stuff. Okay? There's risks that are different than stock risks. Okay? But there is, if you use them correctly, and if you understand, and we're going to get more into why you would buy whatever strike position. Okay? But you have to look at the fact that you can make a lot more per percentage using options. There's different risks than with stocks, but there are different benefits too. Okay? It's just like everything in the world. There's risks and rewards, and you got to know both. But with
Joel,
yeah, go ahead.
Question.
Yeah.
Options, do options only trade during market hours?
Yes.
So therefore, if I have an option on a equity that is tanking at 8 o'clock in the morning, I can do nothing about it and just have to take my lumps.
Yes.
Is that the way it is?
Yes, and that is one of the other problems with options. Now, again, it's not like, what can I come up with? Let's say that you, perfect example. Let's say this, did everybody see, what the hell went down today? Q-Core.
Right.
Quest Core went down like, I don't know what happened, but...
Fat finger trading.
Oh, yeah.
No, it was a bad report.
Lemon, Citron, whatever. I've seen that happen pre-market.
Yeah.
Right. Okay.
At, like 7 o'clock in the morning, like when GE reports at 7 o'clock in the morning.
Right.
I've seen it take a dump. And I was holding it, and I couldn't do a thing about it.
Because you were in options?
8 o'clock.
Because you were in options?
No, I was in the equity.
Okay.
But the options would be the same thing.
The options would be at 9:30 Eastern.
Oh, okay. Well, that's even worse then.
Yes. But
okay,
you have to understand, don't play. I mean, I'm just going to say this. There's a method to play earnings using options. But owning a stock over earnings time is very close to gambling.
So I learned.
Yeah, I mean, that's just, so have I. So's John. So's everybody who's played stocks and options. You You just
Or better not to.
It's really risky, and my only thing is sometimes you have to, because you're underwater. You don't want to lose a stock,
right.
and you are gambling, and I've done it several times. I've gotten lucky too, but I've also eaten it. So
Yeah, I mean, I'm not saying it is. It's a
Yeah.
crapshoot. It's flipping a coin. It's pulling the handle on that, on that slot machine. It's not a true method of,
right.
because nobody,
You, there are plays where you play it up until earnings day,
Right.
like right before earnings day, and get the hell out.
Now, one of the things I will say, okay, and this is very, very important. Never play options that are long options for earnings. Here's why. I won't get into it too deep, but there's a thing called volatility that prices how options are priced. Okay?
Well, that was the other thing I was going to get into.
Right, and I know that. They go up right before earnings. Because why? Well, earnings make things go up and down crazy. Remember, like Priceline.
Right.
Would you rather have the volatility of Priceline, which one do you think is higher volatility, Patty and Sonny? Priceline or Procter and Gamble? Remember the two charts.
Priceline.
Priceline.
Okay.
Priceline.
Yeah.
So
I love Priceline.
those, yeah, I do too. Those those options are very expensive. Well, stocks right before earnings are much like Priceline. Even if they're not great volatile stocks, they go up in volatility. Okay? So maybe, Priceline might be 75 normally. And Procter and Gamble might be a 20 volatility normally. But at options time, Procter and Gamble might go to a 30 volatility. But as soon as they know what happened, as soon as that earnings report comes out, the volatility drops back from 30, an artificially high volatility, back to what it should be.
You're back to watching paint dry.
Yeah, and because of that, the option price drops back, even if you go in the right direction. So playing options at earnings time is very dangerous. Okay? I'll just say that.
So in other words, don't buy a year out and hold.
Oh, a year out is different because the volatility's not as... I'm not going to get into it. But if you're buying this month's option because you want to play the earnings, get out before the earnings comes out.
Okay.
Okay? Because they're going to
Got
go up until earnings. At earnings time, they're going to plunge. Okay, why don't you go on with what you think about volatility, Tommy, and help us out?
All right. On my platform, what I have is probability in the money and out of the money.
Hold on, let me...
When you...
What platform, please?
This is Thinkorswim,
Okay.
TD Ameritrade.
Okay.
I think you can set this with every platform. I'm guessing.
Yeah,
here, 'cause I
most
don't have
all
any
of
other
them.
platform.
Most of them have that.
Okay.
So what do you do there?
Okay.
What we're going to look at is probability of in the money and out of the money, and this helps your choices. I'm looking for a high probability it's going to stay out of the money so I can keep my stock. Does that make sense, everyone?
Yeah.
You're playing percentages here.
Wait a minute.
Yeah,
You said you're looking for a high volatility stock or
Right.
option, so you can keep your stock. You own your stock in your account, do you not? Is this not a covered option?
Right, but you don't want to lose it, like selling the call.
How can you lose it if you own your equity in your
Okay,
equity account?
let's go back for a
and you're
second.
playing an option in an option account.
Let's go back to where Trade for Pay was selling you a piece of paradise. All right?
Yeah.
Now, he sold that to you in the money. Right?
Yeah.
That means he's obligated to give you a piece of paradise.
Right.
Because he sold you that call. So you took that call, right? You bought that call. You're in the money already. He's got to give you that piece of land.
Yes.
This is the same thing. Here, I'm choosing a strike price out of the money. But the market is volatile. It goes up and down all day long. So you don't know if it jumps $5 in a day, all right, or not. And let's say news comes out or earnings or whatever, and we're looking at Veritex here. It jumps. And all of a sudden, your $34 strike price is now $36. The price of the stock went up to $36. It jumped, $8. Well, at expiration, I have to give you all my stock because I sold you that call. Does that make sense?
So the seller writes the call.
Right.
So if you own the stock in your equity account,
right,
and you take an option in your option account,
no,
you lose your equity stock.
Yes. If it gets in the money at $36, it's where I sold. Let's say I sold the call at 34. If it gets to 36. Or even if it gets to 34, if it gets to 35, if it gets to 36, or even further, I lose that 100 share. Okay?
Okay, because you have to sell your stock.
Let me give you an example. A week ago, I owned Veritex. I sold a $36 strike for $3.60. And this is... October.
You sold it? I thought we were buying.
No, we're selling. Buying was in the past. We've switched gears here. We're selling the call. Remember, you buy 100 shares of stock. So Veritex is $28.82. So let's say $29. Remember that?
I had to run out of the office for a minute, so I may have missed that part. I can pick it up later, but keep going.
So in December, what I did is I jumped ahead, and I sold the $36 strike, and the premium was $3.60 for December. All right?
Mm-hmm.
Now, between now and December, that third Friday in December, if this gets to $36, they will take my stock. And my actual price of paying for it was $27.48. So, not only will I make the difference between 27 and 36, I will also take the premium of $3.60.
So that's $12 a share.
Yeah.
Okay.
So I'm looking to keep this stock. I don't want to get rid of it. The volatility is good because it keeps the premiums high. But how do we look at volatility? In December, Trade for Pay, can you go to December?
Sure can. In Veritex, right?
Veritex, yeah.
Okay. There's December.
All right, December. Now go to the top. You see on the right-hand side, it has a 103.77% chance that it'll reach that price. All right, and there's a $13 swing up and down. You see that? It's a real volatile stock because you never know what's going to happen. They're suing Apple, they're suing Microsoft, they're suing everybody. All this company does, they hold patents. And if you infringe on their patent, they will sue you. and they make their money that way. And they have a pricing program where if you want to buy the rights for their use, and it's the 4G LTE rights, and a lot of people have infringed on it, and they're suing the hell out of them. So that's why this stock is volatile, is because news brings the price up or down. All right,
Okay.
that makes sense?
Got it.
This $13 swing, $13.25 swing, there's a 103% chance it will do that. And if you see, I'm only out of the money by a few dollars here.
Mm-hmm.
$8.
I don't see this on the. Where do you get the 103? Where do you see that?
You see where it says December on Trade for Pay's screen?
Yes, yeah,
Look
but at
all
what
the way
strike
to the
price?
right. Look all the way to the right.
Yeah.
Follow December. Look all the way to the right.
I
Trade
got
for
it.
Pay.
I got
Right
it.
there.
Yeah.
You see it? See the yellow dot?
See here, it's
Patty cakes? Are you looking at Trade for Pay's screen?
let me bring this down.
Oh, okay. There it is.
Yeah, it's 103.77% chance that it will be in that zone. And I'm willing to take that chance. Why? Because there's a $12 built in, of gain per share. That's a lot of money. So is it worth taking the risk? For me, it is. For some of you, I'm not sure.
But here,
Yeah, that's an individual
but
thing.
think of this.
Right.
Okay? You want to have, this is not a thing like I do or Tommy does. We get in and out of Apple. I get in and
Right.
out of oil futures. Sonny, you're looking at getting in and out of other futures. That stuff you're going to do is fast trades. You want to get in, you want to get out. It's what John does. Okay?
Okay.
This is more, I want some income stream just the same as if I put my money in a bank, but there's no bank that gives you any money interest-wise now, right?
Right.
Exactly. And that's why I do. This is mainly, a lot of my options are in my IRA account.
Right.
I have a fairly large sum of money from, working as a telephone man, and I took that pension fund and threw it in a trading account. And basically, I opened up an option account for it, and just today, I sold a December 31 strike for $4.40. Two of them, as a matter of fact. So I made $880 today
Wow.
in that account.
Now, what's the worst that can happen?
And the
Here,
price is right.
think about this. He sold them for $440. Okay? Price today is
Yeah.
$29, I'm going to call it. Okay?
Yeah.
If he did this, it's called a covered call if you do it when you own the stock. Okay?
Right. And I do.
It's called a buy right when you do this as a one single entity purchase. You buy the stock and you sell the call against that stock. Okay? Number one, it's allowed in IRAs, 401ks, SEPs, and any other qualified plan. Qualified meaning it's qualified for tax benefits of being, a retirement plan. Okay?
Right.
So, he could take the $2,800, $2,900, I'll just call it for one, for 100 shares. He could take that and put it in the bank, and he could probably get 80 cents a year in interest or something.
Right.
I'm not sure that much.
I mean, look at the difference.
Okay, but it might
might
be
be
8
cents.
cents. That's right. But what he could do is he takes this, puts his $2,900 up to buy the stock today. Just do it. And here he's taking that, and he goes ahead and he says, aha, what I'm going to do is catch some fool. And I can hear him say, I'm going to catch some fool.
Right.
And
right.
he'll go ahead and sell that for, the $440. Okay? It's for December. What's the worst that can happen? Because this is what happened in my stuff. Remember, think of me now. I own my piece of paradise. And I sold to you a call. I, in essence, sold a covered call against my piece of paradise. Okay.
Got it.
If you bought it for that $1,000,001 and it was worth $100 today and I got $50, okay, how much did I make by having to sell it to you? Patty or Sonny?
100,000, 100
plus the
150.
yeah,
Oh.
$150,000 on my $1,000,000. How much percentage is that? That's 15%. Okay.
Cool.
So
Okay.
Tom's doing this every month or every couple of months.
Right.
So this isn't the same thing as, hey, like Patty, you were saying, man, if I'd have bought that, Apple call at $570 and it went to $702 today, look how much I'd have made. That's big profit stuff. This is more what you do to keep income stream going.
Right. You're
This is
chipping
slow
away.
and
That's right.
Right. Yeah.
Okay.
I mean, sometimes you get stuck with your stock that, you're trying to unload it, except you're so far underwater. Another way of making it back is selling the covered call. But sell it out far enough where you don't lose your stock. Does that make sense?
Yeah.
You're so far out of the money. Not in the money, but out of the money.
Right.
Yeah.
Like go $5, $7, $9 out and take a chunk. And then, you do that every month. You keep taking chunks, and maybe every 2 months that you can do it. Because the volatility between this month and 3 months ago were huge. I mean, you could have made $6, $7 in a month, in premiums, just in VHC, because the volatility was so high.
So, Tommy, what you're saying is if you're underwater on your equity,
Right.
and say I'm using simple little numbers here.
All right.
Let's say you bought it at $100,
right.
and it's now $90. So you're
All right. Let me
in the
give
red
you.
$10.
All right. Let me
So
give
now what
everybody
you
an
do
example.
is you buy a covered call
Right.
at 90.
Well, no, hang on a second. What you're going to do, I bought Deckers a while back, and because of downgrades after downgrades, I got stuck underwater. I didn't want to lose this stock. It's a great stock when it was rolling, and I bought it at $104.67 on an average. Okay, this stock now is worth $40.31. So how far underwater am I? Okay.
You're drowning.
I'm drowning, exactly. So what do I do to make that money back? Okay? What I did is I went out to, I sold the call January 14, all right? January of 2014 for $5. And I own 400 shares. So 4 calls at $5 is $2,000. Okay?
Mm-hmm.
Now, if I keep chipping it away like that, and right now I could buy it back for $5 because the price of Deckers has fallen, and we've seen it free fall today, $2.64. All right. So I sold the January 14 strike price of 60 because they'll never see 60 again because of all the downgrades. I shouldn't say that, but it might. For $5 strike price, a premium. So I took $2,000 in. All right, I could buy that back for $2,000 and then just ride the stock out, but I'm not going to do that. It's not worth it. All right. So when it comes to a lower buyback price, I'll buy it back for a slight amount, and I'll keep most of my $2,000. Does that make sense?
Okay.
You can buy your way out of this.
So are you doing, if I understand this, are you, when you're
This is
selling
called
it, is it selling to open? Is that what that is?
No. I own the underlying. I own the stock. I'm selling the call.
So you don't have to buy
Could be
the call
called
in the first place to be able to sell it.
Right.
Okay.
Because you own the underlying already.
Got it.
I guess it
understand
is
now.
called sell to open.
When you're doing your transaction on your platform.
It is sell to open. Sell one Decker's call 100 January 14, $60 call at $4.10 limit to open. Yeah, that's what it says.
Okay, got it. All right.
So that's called a leap because I went not from 2012, I went to 2014. It's called a leap.
So that's a leap.
That's a leap. You're going to a different year.
All right, got it.
Does that make sense?
Yes. So when
I think I got it.
when you're using your platform there and you're using probability, is it the probability is the odds that it's going to get to that price in that time?
Well, there's two probabilities. There's probability of out of the money, and what I just told you, it's 82%, 82.25% out of the money. There's a 17.76% chance it will get in the money. Now, do you like those odds?
Say it again.
It's an 82.25% chance of
What are
being
we
out
looking at?
of the money.
Okay.
Deckers, January 14.
D-E-C-K.
ECK.
Okay, got Decker.
Yeah.
January 13 or 14?
14. It's a leap. It's a huge leap.
Is it ever?
Oh, yeah.
Like leap year.
It's long expiration.
Right.
And you said 60 strike price?
60 strike.
Yeah, okay. So,
Okay.
82.24%
Right.
that it's not going to be
Out of the money.
$60?
Right. It's going to be out of the money.
So that's pretty shitty, isn't it? I mean, oops.
Well, no. It's shitty.
Remember,
for them.
does he
It's not
want
shitty
it
for
to
me.
be in the money?
Yeah, okay.
This is good. Yeah,
Right.
I don't want. Yeah, if it's in the money, it's a bad deal because I'll lose, like $25,000 in stock. I mean, that's a lot of money.
Right, yes, okay.
Now, this may or may not be the best way to do. Tommy's trying to repair something. Okay?
Right. This is if you have stock that's underwater and you don't want to lose it, you don't want to lose your capital, and what you're trying to do is
Preschool?
a little above, but it helps
Yeah,
people.
I think so.
But it helps people who are holding stock. They can't get rid of.
And there's
You know what I'm
another
saying?
thing that I'll talk about.
And there's a way of making
That
income.
someday I'm going to talk about, which is called a collar.
Yeah.
Well,
Can
that's
we
why
stick
I'm
to
not going
preschool for
into it.
now?
What you do there is you
Thank you.
buy, you sell your call and you buy a put so that if it goes down, but that's way out of preschool. Stock banded, you keep your dividends. Because you own the underlying. Yeah.
Right, you own the stock already.
Now, boy, I'll tell you.
And the thing is, there's an 82% probability that you're not going to get rid of this stock, and that's what you're looking at. So yeah, I'll get dividends if they're paying dividends all the way up until January 14th at expiration. And if I keep
Now,
my
I'm
stock,
going to
it'll keep
bring up
going.
something else that's real good to know. Okay. If you look on any of the option charts, you know, not charts, but option chains, there's a thing called delta. Delta has two parts that it does. Number one, delta is the percent that you're going to get back for the underlying moving a dollar. So generally at the money, I'm going to look at Decker, and we're going to go to December 12, you know, this December. The 42.5 has a 52 delta. So basically what that's on the call, basically what that's saying, let me move this over so that you guys can see it. Basically what that's saying is if Decker goes up a dollar from 41.31 to 42.31, your option will increase approximately 52 cents. Okay? But it also has another meaning that's real important and handy to know. It's also approximately the probability that this stock is going to be in the money by at least a penny at expiration. So if I go out and look at, let's say on Decker, at my 2012 52.50, so it's got to go up $11. It's got to go up 25% in 3 months. Can it do it? Sure. But the delta at that point is 23%. I'm not looking to make money on the covered call. I'm looking to pick up some money. So the covered call for December would give me back about $1.35, $1.30. But there's only a 23% that it's going to expire in the money. Okay? If it doesn't expire in the money, you pocket your $1.40 or $1.30 or whatever that is, and you got a 23% or a 67% chance, 77% chance this thing is not even going to be taken away from you. Okay? So using delta allows you also to figure out not just in the money or out of the money, but expiration time. Is it going to be in the money by at least a penny? So that's that one.
All right. Any other questions?
My brain's full.
Did that throw you too much? No, the problem
No,
is
it's
that's, again, we're getting into Greeks, and Greeks are a lot. I mean, it's why I didn't start out with it. You know, we're at options.
Right.
You know, we're at options preschool, and I threw in some first or second grade stuff. Okay.
That's why I'm falling down. I just put a crawl and you want me to
It is a little heavy, and it'll
the
come
more
to
you hear
the more
it,
you play with it. Yeah.
But if you don't understand it, what good does it do you? Because you're still in preschool learning to crawl, and everybody around you is running, and you don't know how to do it.
You don't look at it like that, because it took me a long time to learn this too. I mean, I sought out people who knew what they were talking about and kept asking questions. And finally, I got a hold of Epic, and he walked me through my platform, step by step. And the more I did that on my own, the easier it got. It's like riding a bicycle. Somebody's got to hold you until
Yeah,
they
but
let
you
you
got to
go
know
and
that
fly
you
on your
pedal
own.
the pedals, even if you don't know it.
Exactly. Yeah. So after I made a few covered calls, I was calling Epic and saying, hey, I made this, trade. I sold a call. He goes, wow, that was good, because he looked it over and saw it on his platform. And the other thing I want to recommend is get a trading partner. I mean, I have to admit, I have great people around me. Trade for Pay. Okay. I got Epic. I have Cousin Vinny. They're Vester. I mean, these are great people. Sunny helps me out a ton. I mean, she's in so many books, I can't read them all.
I haven't said them all yet, Tom.
Yeah, there's RJ. I mean, that Trader Spotlight was priceless. It put me in a whole new option trading area that I never thought I'd be in. It's like scalping the ES.
Yeah.
I mean, Apple moves like that. Well, today was kind of dull. Oh, yeah.
Gas.
I forgot Gas. Gas helped me out. Yeah, Dr. Gas. Yeah, so there's a lot of people in this room that will help you. And get a trading partner. Seriously, it really does help.
And get somebody who's a little bit more advanced, but you're not going to get somebody, necessarily that's going to be able to teach you, because they're trying to make money themselves.
Right. Hey, spend cattle. Bernie Madoff can't Skype, so he can't help you.
Gas is going to $10,000 a month for his help.
Oh, man.
I know, but he's
those
a
are
doctor.
doctor's fees, man. Does our
You got
insurance
to ask
cover that?
Gas that.
Oh, jeez. Come on, Gas.
He'll send you to his insurance specialist.
Yeah, right. Does Medicare cover it? I'm getting
Yeah,
real
me
old.
too.
Does Medicare cover what?
Do I get a discount?
Oh,
for
sure
my
you
ARP
get
card?
that, man.
As I understand it, that ARP card is for your supplemental. Medicare is Medicare.
See,
from what I
now,
hear.
Stock Bandit, there's a great guy. He's going to help for free. You're just... And
There you
Bandit
go.
is one of the
Bandit's
best in the
good, too.
room.
I've seen his trade. That's right. Did you feed the hogs there, Stock Bandit? He said walk the dog and feed the hogs.
McMill, you posted Joel come back to that last part
let me
again.
do that. I'm sorry, McMill. Let me do that. Hold on. Yeah, you
that's a
talk about
delta?
the delta, right, McMill? To put a 1 or a yes.
McMill. Maybe he doesn't have ears on. Yeah, he's got to have his ears on.
Okay, very simple. Delta has 2 separate meanings. The one that everybody knows about is delta equals dollar. This is how me as a stupid person, got it. Okay? So I'm not going to go into the rest of the Greeks tonight. Okay. But delta equals dollar. It's the most important one to know for basic, because you want to know if the underlying goes up by $1, what are you going to approximately go up on your option? Delta, no. You're going to go up. Delta is going to be the number of percent for each dollar the underlying goes up. So if I look at the 47.50 in December on Decker, the delta is 36 cents. So I'll do that in a minute, Captain Trader, but hold on. What you're looking at, that means, is if Decker goes up by $1, goes from 41.31 to 42.31. Okay? And you own the 47.50, which has a delta of 0.36. See you later, RPM. Go blow off some steam and some ammo. You're going to go up 36 cents for the dollar that the underlying stock of Decker went up. Does that make sense to everybody? Okay.
Yep.
Okay.
Yes.
There's another thing that delta also gives you, though, and this is an approximation. Okay? It also is the probability of this expiring in the money at expiration. Okay? So there's a 36% probability of Decker expiring in the money, the 47.50, expiring in the money on the third Friday in December. Okay? So, the two parts of delta. One is delta is the percentage of dollar that the option that you buy is going to go up per dollar. The other is what's the percentage of probability that it's going to expire in the money by at least a penny. Okay? Okay. Captain Trader, Delta, just real simple stuff. Delta means dollars. You know, I probably shouldn't get into this because that's going to be over the top. Theta, yeah.
Yeah, it's gonna be,
theta is time and
101.
vega is volatility. But more than that, I'm not going to do. The spread profit will be is above on October. Let me go to October. The spread profit is above 40. I don't know what you mean, Frankenstein, unless you were making a statement. Okay. Any other questions?
Well, I'm going to second what Patty has already said. My brain's full.
Wow.
And I will be reviewing the video several times.
We're all
Guys,
burnt out.
Yeah.
It's a lot of information.
it is,
in a
and that's
short
why
amount
we
of
did
time.
this, you know, that percentage of probability of being in the money and out of the money and that stuff comes into big plays when you're doing spreads and things like WhatCall does.
Okay, Joey has a question, Trey.
Right.
Where's
Okay,
Joey?
Joey
I
has a
get the
question,
delta.
Trey.
Please tell me the dollar amount, but I'm confused about the percentage up. Are you talking about it being the percentage of being in the money?
Oh, I think that's what it is.
Okay.
Right, I think that's what it is.
Delta, and I'm going to...
Joey said the percentage
Okay.
move.
Percentage move. I'm going to guess that you mean the percentage of probability of being in the money, or being at expiration being in the money. Okay. Darth Trader, here's the situation. That's a general rule that you should I never hold weeklies overnight? How do I know when I'll get smoked? I very seldom hold weeklies over the weekend because you lose time value, which is called theta, but don't worry about it. But generally, I hold weeklies overnight. You the same, Tommy? I mean, I do.
Yeah, you can. I have. I mean, I'm doing it. I'm doing it now. I've got 4
Yeah.
calls on Apple being held overnight. Not that I choose to.
Right.
Today,
I mean,
but it just happened that way.
weeklies are no different. It's just you have a very short period of time till it expires. And and they're very cheap, and we're not gonna do that
cheap.
today because that's really a little past.
That's like a scalping.
Yeah, and that's
like a
that's
scalping
way
thing.
out of this one. That's 3rd, 4th grade maybe. That might
Yeah.
even be 5th or 6th.
Right.
Are you holding Apple stock?
No, calls. I bought 4
Fine.
calls. And truthfully, one of them I've been holding for 3 days.
Okay, but you're not holding Apple stock. You're just
Well,
simply saying.
I have 10 common.
Okay,
And
that's what.
from $573.
Yeah, but
I'm keeping them.
That
Yeah,
is
I guess
different.
so.
What
Yeah,
he's doing here is playing for
Right.
quick profit. Yes, that's what
Right.
what Tommy's
He's scalping.
doing there, Patty. And he does.
Right.
Okay.
I was
I
hoping to
told
get
you.
rid of them. I kind of held on a little too long.
I
thought there was
told
going to be
you, you
a
fool.
huge rise at the end of the day. Yeah, I know. Tomorrow,
Now, Darth,
new day.
there's no general rule. It really has to be. You have to go ahead and know what the implied volatility is compared to before. That's really, really junior high at least. Okay? I have something on that, but it's nowhere near where we are. But you want to buy options when the implied volatility is low, because that means the options are low in price. Okay? You want to sell options when the volatility is high, because high volatility means the prices of the option are high, and hopefully the option volatility goes down and you'll make money no matter what. Way, way, way out of an options preschool type of thing. We'll go over that, but it's going to take a little bit of time. Okay? Yeah. Guys, you two can drop off if you wish. And Tommy, you can too, but, we might get... Okay, if you two want to drop off, because I don't think there's any more questions to ask. Thank you, Patty Cakes and
Thanks,
Sonny.
Sonny.
You guys
Thanks,
have
Patty
been
Cake.
great. Did you learn tonight?
Yes,
Oh,
I
yeah.
did, Joel, and I want to thank you very much for being patient
Okay.
and being such a great teacher.
Okay. And guys,
Exactly. Ditto.
And
Thank
Tommy,
you.
we love you too, but you kind of
Right.
confuse me.
Well, yeah. I'm still a
Tommy's
rookie at
doing
this, trust
exactly
me.
what he
I'm no
does
expert.
perfectly. He found a thing that gives him
I'm
what
trying.
he wants, some income, and he's working on that specific piece to try.
Right.
But
And
he
mainly
did
it's
give me a
repairing-
great idea, and that's to take my IRA
Right.
and put it in a trading account and find somebody to be my trading
But you want to
partner on
learn it
options.
yourself, because
There you
every
go.
trading
So-
partner can screw you over because they have a valid idea.
Absolutely. And the one thing I have learned in life is learn to do what you want to do
And
don't
also
depend
learn
on
how
anybody
it
but
works.
yourself.
That's what this is about. Don't go ahead
Exactly.
and say,
Yes.
I'm going to get a trading partner and they'll make me money. Learn to be the trading partner.
No. I
Okay?
didn't mean that.
That's all I could say because it scares me when people say, I mean, I've been in rooms where you pay hundreds of dollars a month. Okay? And the people have been terrible. Okay? So what
Yeah,
I'm
I've been in
saying
one too.
is learn it, study it. Anytime you need to ask, I will give you some things to think about. But don't just say, oh boy, because I got a trading partner, I'm going to be better. Learn to do it yourself.
Oh, I know that's
Oh,
no. I'm saying
right. You
I
have to pull
gotta
the trigger.
learn to do it for myself, and having a trading partner, somebody
Right.
to talk to bounce ideas off of.
Exactly.
Yeah,
But the
you got to
decision
understand,
is
we have an
always
option
mine.
or a Apple trading room. Nobody follows anybody in that room without knowing what they're doing. Because if you do, you're going to lose on Apple, and when you lose on Apple, it ain't $100. It can be in the four figures. Okay.
No,
Yeah. Yeah.
yeah. No, the
Two
one thing I
Fridays
know is I
ago.
need to do things for myself, and I am
Yeah,
responsible
yeah.
for my decisions, and nobody else is.
Yeah. Two
Right.
Fridays
And
ago.
I think everybody needs to do that.
You'll make it back. You just got to keep getting on the saddle and keep riding that horse.
Yeah.
Because it'll throw you off, but you got to keep getting on.
Did
What?
you guys see what Army vet turned trader just said? Awesome, man. Never assume
You
anyone
can.
has
And even
has your
if they
best interest
do,
in mind.
even if they do, Army vet, that
So
doesn't
true.
mean
Yeah.
that their best interest is your best interest, nor does it mean they're right. That's what I've found. They may think, oh man, I got that guy's best interest in mind. Damn, I'm going to help him out and really get it going. No, I don't tell anybody. The reason I'm not on a show and telling people how to trade or what to trade, I don't mean how to trade, what to trade, is because I don't know what their goals are, and I don't want to be responsible for that poor guy who is, exactly, you got it. You know what I'm saying. And thank you for your time and your post, Army vet. What I'm going to say is this, guys. This is just a preschool. Pick a few. Stock Bandit is awesome at short.
He does the put side, which I
Okay, and that's
I know
that's
slightly.
next week a little, maybe 2 weeks. I'm going to see if I want to do that in the next. But he sells. He does a very, very risky trade for a newbie. But he learned it, and he learned it well, and he learned it so that he feels comfortable with it. And that's what you got to do with anything, especially trading. Okay? Too many people hope that, too many people hope that somebody's going to make them money in this world, and it isn't. Stock Bandit, I'm going to say this, CBOE and 1-800 options, I think it is. I can't think of the site now.
Yeah, I want to know if you can get to this site, Trade for Pay, just to help people out with covered calls.
Okay.
It's the Aversham.
Yeah, put it into
Let me see if I can get it up
the
here.
room, and I'll bring it up.
I'll put it in the room.
No.
Or give me a second here.
Okay, I will.
Yeah. Yeah. All right, thanks. That's fairly long, but...
Okay,
try that.
Let's see here.
I'm not going to go there. It will just
Okay,
confuse
guys,
me.
this is something that Tommy found. This has a lot of things on covered calls, covered puts.
Right. A Bry guy put it up last week. He didn't get a lot into it, but basically it gives you options, strike prices with the premiums on there. Some of them are deep in the money, so be careful on what you're choosing. Look on your platform first.
Okay, I won't go into this, but... Oops. Oh, hold on.
If you click covered call on the left there,
oh,
Trade for
what
Pay.
did I do? I blew it out here.
Strategy screener.
Let me go back.
It's all right.
Thank you, sir.
We'll forgive you this time.
Okay.
Hey, you're welcome, Army vet. Thanks for serving.
Okay, there's covered calls. Yep.
Yeah.
Panel.
Click covered calls. You should
First
bring up
one.
a list. Well, basically what it does, it lists the strikes
nice.
with the premiums. Yeah.
How accurate is it compared to your platform?
Well, it's a little delayed, so like I said, be careful what you're looking at. Because, you know, we're looking at it after hours, so things change once we get in the, you know, the
Oh,
regular,
yeah.
Yeah,
regular
spent
trading
cattle,
hours.
you theoretically could buy 1 month or 2 months options and recover all the premiums by selling weeklies against it.
Right.
That's a different thing. That's a calendar spread, and those are very, very good. I mean, but that's a different thing. There's so many things that, you know, first of all, if you know that one of the nice things about options, I'm going to bring this down here, Tommy.
Yeah, well, I just wanted to point out one thing. If you're looking at open bids with the $sign after it, that's the premium. Just an FYI.
Yes. Now, here's something from Bry Guy, dual stochastics. By the way, Bry Guy, that was good. Platform forum. Let me go into the forum here. Trading discussions. If you go into the forum, there's options trades. Down at the bottom, I have options education trade sites. So if you're the two that are great are options education org. I'm going to put this into the room. And I used to, Boca Dude, in what I used to do, let me put this into the room. What I do is play leaps as in lieu of buying the covered call. In other words, instead of buying the stock itself, I'll buy leaps and sell off, you know, monthly options against it. Yeah, that's exactly it. Goodbyes. Goodbyes. Maybe you could be on sometime. This is great. Tommy, you know, one of the before I say this, on the CBOE, which is Chicago Board of Options Exchange, they have a
Yes.
education school for free. And I joined that
Right.
years
I've seen
ago. I think I never got past first grade, but you know, uh, if anybody really wants to get good at options, it's great. But this site here that I just put into the room is in our trading forum for members, and it does give you quite a bit of information to, you know, sites to go to. There's also under options trades, there's a lot of great articles from Bry Guy, from Die Laughing, from Learjet, myself. Ryan G. Vale has some great stuff in there. You know, Epic and Moraney. Great stuff in our forum now. And I suggest people go there to you know, learn this stuff. Guys, I think I'm done. Tommy, you got anything else, buddy?
No, I'm done. I mean,
Okay.
any questions?
Guys, I
Any
think
more
we're done
questions?
for tonight and probably for
All right.
yes.
Thanks for joining.
You're welcome, Sonny.
Thanks for doing this, guys.
Patty
It was
cakes,
helpful.
Sonny.
thanks.
Thank
Good
you,
night.
Patty
Good
Cakes.
night. Goodbye. I'm going to eat.
Good night, all.
Good night, everyone.
Thank you.
Good night and thank you.
All right. Thank you.
Okay.